Hi, I'm Rachel, the CEO of Intrinio. In this video, I'm going to talk about how financial institutions are starting to behave like fintech companies. And here's why. At Intrinio, we've made financial data easier and more affordable for anyone that wants to innovate or build on top of the data. I'm talking about websites, dashboards, algorithms, you name it. Historically, this meant that our client base was full of fintech companies like Robinhood, Domain Money, FTX, MarketBeat, Alpaca. However, over the past year, we've seen an influx of larger, more traditional companies like asset management firms, banks, brokerage platforms, and hedge funds come to us looking for data. They're stepping away from the Bloomberg terminal and starting to innovate around it. They need great developer tools, fast access, and scalable pricing. Side note, the Bloomberg terminal or Icon or FactSet software, they're all incredibly valuable and important tools, and they aren't going anywhere. These workstations are great for analysts who want to look at the data and analyze it. But you can't build with the data inside of these platforms. In this video, we're talking about innovating and building tools and platforms organically outside of the terminal or workstation. Argue that institutions that aren't behaving like fintechs are fatally behind already. In fact, everyone is becoming a fintech through the process of embedded finance. You can finance purchases at Home Depot and pay for your Starbucks with the Starbucks app now. In fact, as long as you aren't taking payment in the form of checks in the mail, your business is a fintech too. As Matt Harris of Bain Capital Ventures once said, we'll eventually talk about fintech companies the same way that we now talk about internet companies. This is true, but the trend hits financial institutions with particular force because it requires them to reinvent the entirety of their products and identities. There are three major catalysts that jump-started innovation inside of these bigger financial institutions: competitive pressure, customer evolution, and tech advancement. Let's talk about the competition first. Robinhood, Alpaca, IEX, Memex, Embed, Titan, RealizeFi, Betterment, Coinbase, and so many more. Robinhood saw the path of lower commissions and decided to head straight to $0, forcing other brokerages to follow suit or lose out. Betterment and Wealthfront have proved that users want streamlined platforms where they can grow their wealth. Titan's mission is to allow all investors, not just accredited or wealthy ones, to have access to invest in a hedge fund, and it's paying off with $500 million in assets under management. So, which institutions are feeling this pressure? Brokerage firms, stock exchanges, clearinghouses, and traditional banks have all started to respond. We're seeing these firms shoot back at the most basic level by starting to redesign their outdated platforms to get up to speed, but they've been a bit hesitant to chop up their existing business models. Some of them are branching into crypto to keep up. For example, Fidelity will be allowing 401k participants to put money into Bitcoin by the end of 2022 and promised more cryptocurrencies to come. Others have chosen the M&A route. For example, UBS acquired Wealthfront for $1.4 billion just this year. All right, competition is an obvious reason for these larger companies to start behaving like startups, but it is not the only one. For any business in any industry, the customers control the narrative and heavily influence strategic direction. If you've been paying attention to the investment landscape lately, you'll notice that this customer base in particular has gone through a complete transformation. Retail trading volume, sophistication, and demand for transparency has exploded. Younger investors now more than ever want to see how their companies perform, both on the ticker tape and in society. When faced with the prospect of moving their business to a more innovative fintech platform, these customers are starting to demand more from their traditional platforms. This is affecting banks and investment firms the most. We've seen these institutions at Intrinio respond by building their own mobile apps, adding more sophisticated features to their platforms, redesigning their outdated UIs, and increasing transparency and visibility into portfolios through dashboards. Take a look at Goldman's Marcus platform, Ally Bank, or any robo-advisor for some good examples. The third and final trend that is molding traditional financial institutions into fintechs is the general advancement of technology. And I know that's pretty broad, so we'll break it down. First off, machine learning, natural language processing, and artificial intelligence have reached their iPhone moment and are now widely and openly available to anyone who's interested. In this space, we see hedge funds transforming into quant funds, fundamental strategies becoming quantamental, AI chatbots for customer support popping up, and much more. Separately, blockchain applications have swarmed financial services, credit scoring, bills of lading, insurance claim processing, and even stock exchanges, which are starting to incorporate blockchain into their infrastructure. Technology has also, in general, enabled faster and wider collection of valuable data sets, magnifying the never-ending search for alpha. This is shepherded in the data economy and the proliferation of data marketplaces, which in particular have become a popular business model that many traditional stock exchanges are bolting on in order to diversify and hedge. In all three of these cases, financial services firms are leveling up their tech talent, their tech platforms, and massively improving their ability to source, consume, control, and make use of massive amounts of data. Okay, so things are changing inside financial institutions due to competitive pressures, customer evolution, and tech advancement. You might say that big businesses are starting to behave like startups. We call this institutional entrepreneurship. The confluence of trends has financial institutions under pressure to innovate, just like startups do. Small projects are popping up inside of these firms, and they're starting to move quickly outside of the traditional corporate bounds. These teams are under pressure to innovate and build fast with the latest and best technology and data without spending a lot of money. They've got to prove it to their bosses that there's reward behind the risk and all the spend as they rush to catch up technologically. Think of it as mini startups within a big company. Okay, but what happens when an institution behaves like a fintech? The first and most palpable effect is a culture clash. Spend a day in a startup office and you will see what I mean. Problem solving and radical innovation are not the same thing. Rocking the boat is required, but culturally terrifying for institutional employees. There's also a speed clash, which requires traditional conservatism to be upended by less planning, risk aversion, and resource hoarding. This all boils down to a risk mismatch. The bigger a company gets, the less risk it takes. But if you are trying to keep up with fintech, you just have to. And it is wildly uncomfortable for those that aren't used to it. Lastly, there's this complete upheaval of traditional processes. You can't spend months building a project plan in a Gantt chart or waiting for approval from 7 different layers of management if you're going to compete with Robinhood. There are cases, of course, where institutions do stand their ground. In Hamilton Helmer's book, 7 Powers, The Foundation of Business Strategy, he explains the concept of counter-positioning. This is what happens when a newcomer adopts a new, superior business model which the incumbent does not mimic due to anticipated damage to their existing business. Some say evolve or die, but there are plenty of companies who have successfully held the line, like Bloomberg, for example. One downstream effect of all of this change has been the sheer amount of tech and platforms that institutions have had to adopt in order to support this innovation surge. To behave like a startup or a fintech company and truly innovate, these institutions need cloud technologies like AWS, better collaboration tools like Slack, modern UIs, and so much more. In the capital market space, they're also reconsidering their data providers. Data is a wildly important factor in a fintech project. Unfortunately, the data infrastructure and business models of traditional vendors, which these institutions are used to, don't support innovative use cases. In this case, forcing a square peg into a round hole can be particularly catastrophic. Here is what the traditional data procurement process often looks like with large vendors that these financial institutions are used to. Now, this is just not going to work for modern developers, innovators, and data scientists. Keep in mind that they are under pressure to build fast and affordably, but are still under the scrutiny of delivering a high quality and reliable product. Now, here's what the data procurement process looks like at Intrinio. Platforms like Intrinio are an oasis for innovators inside of these larger firms, and that's exactly why we've noticed the acceleration of financial institutions behaving like fintechs. All right, we've covered a lot. So what other downstream effects do you predict when traditional financial institutions start to act like fintechs? Drop a comment so we can discuss. If this video was helpful, please make sure to give it a like and subscribe to our channel for more fintech and financial data content. Thank you for listening, and as we always like to say at Intrinio, we can't wait to see what you build.